All right, welcome back to our special new podcast series, The 20-Minute Investor, where my partner Nathan and I bring you actionable nuggets and insights from our real estate investing journeys in bite-sized 20-minute episodes. I'm Aaron Amin. My wife and I built a portfolio of 8 cash flowing rentals across 3 states while working full-time and raising a young family.
And I'm Nathan, a husband, father, technology executive who built a portfolio of cash flowing rentals across 2 states from over 2,000 miles away.
Together, we co-founded the Remote Real Estate Academy, where we coach investors on how to build their own portfolios of cash flowing rentals from anywhere in the world. So every week, we're going to pull back on different topics that some of our members have maybe asked us, or things that we're working on that we think might be useful. And like I said, we're going to keep it to 20 minutes and under so we can respect everyone's time, including our own. So this past week, we did a bit of polling inside of our community to try and see what was on people's minds. Was it big picture strategy stuff? Was there some specific part of the investing process they were stuck on? And we got a couple good responses, one of which was a really kind of high level question that I think would be fun to spend some time on. And it was about, am I playing the game right? This was from someone who already has a portfolio. They've already invested across multiple states, but they're hitting the kind of common valley of despair where they're a few years into their journey and some stuff has broken, gone wrong on the CapEx side. There's been an eviction, some of the pains that are more or less inevitable when you play the rental game for long enough, but they hurt nonetheless. And I can tell that what he's looking for is some validation that, hey, is this the right game? Even though some of this stuff really sucks and it's really getting him down. So Nathan, what do you think? What's the kind of first part of answering that question?
Well, the first thing that comes to mind is I think we've all been there. And I say that tongue in cheek, but it really is more about, I think it's part of the journey, right? I'm sure someone out there has the perfect real estate journey and nothing ever goes wrong or nothing ever went wrong and all is good. But I think more often than not, for most people, that's maybe part of the game, right? The one thing that I heard or I was told when I started my journey that I try to keep in mind every single day when I do anything related to real estate. Somebody said something to me, or I heard it somewhere, I can't remember, along the lines of, as long as you're ready, mentally, financially, process, people, network, whatever it is, as long as you're ready and you know that crap's going to hit the fan, then you'll be fine. Right? That's something that just stuck to my mind and I keep in my mind all the time because there's always stuff that is going to happen, right? And there's stuff that happens all the time. I've had evictions. I've had trees fall on my houses or one house in this case, but, through after storms. And as long as I think you're mentally and financially prepared and you know that it's just part of the game, then at least for me, it really just helps get through this kind of stuff.
Yeah,
how about
100%.
you?
Yeah,
What's
100%.
Yeah.
I think expectations are a very important part of it. And sometimes there's a false sense of security, especially when you buy newer properties in nicer areas with stable tenants that are renewing their lease year after year. When things don't go wrong, it creates this sense of security, which is well earned, right? If you bought a good house in a good area and you have good tenant screening processes and you are a good landlord, then yes, it's less likely for things to go wrong, but it is still 100% inevitable that you will have CapEx events, that you will have a tenant that hits a hard time. There could be events totally outside of their control, outside of your control, that really affect what happens with your portfolio. And if you're not expecting that, no matter when, right, it could occur on day 1 or it could occur on year 3. I think that's something hard to grapple with. But even if you do expect it, this is where I think it gets tough. Like, even if you set your expectations, hey, something's going to happen, it's just a matter of when, you're saving money in your reserve accounts, it still sucks.
No fun when it happens, that's for sure.
And just one anecdote there is that, like, in 2023, there was a 6-month period where there was not a single vacancy, not a single missed rent payment, not a single repair, not a single CapEx expense on my 8 property portfolio across 3 states. And I didn't get any calls. It was like just felt like true mailbox money. Yeah, it felt like a dream, right? And that's great. We were still stuffing away reserves. And for the most part, I don't touch those operating accounts. Like, I don't draw down on them monthly for personal expenses. So it was great. We were building up this big cushion. Then one of our tenants went missing for 37 days. And that started a snowball of events over the winter where there was this like, I think it was about an 8-week stretch where 6 of those 8 properties all had major between $1,000 and $4,000 expenses in a really short period of time. So that entire reserve allocation was evaporated very quickly. And then it was all of a sudden my reserve was back down. And so if 6 more things went wrong, we were going to be dipping into our own pocket. I share that because at that point in my journey, I was far enough to know to expect bad things to happen. But you can't control when those things happen all at the same time. And you certainly can't control how your emotional reaction is when those things do happen. You can insulate as best as you can, but I totally validate the feeling of sometimes wondering if you feel like you're playing the right game when stuff like that happens in short succession.
Yeah, they couldn't agree more. I think there's also, which is why I said it the way I did earlier on, but there's really, to me at least, there's 2 parts to this, right? There's the mental aspect, just being prepared, just knowing that stuff's going to happen. And when it does, it does. And of course, at the time or on the moment, it's going to feel very unpleasant. And despite how prepared you are, it's never fun. And you got to absorb that information, that news, and you got to deal with it. I think the other part is the financial aspect, right? Because I think even if you're mentally prepared, if say you did not have the financial reserves to cope and absorb these events, you would be in a very, very different situation. So that's why, to me, it's really important to have both of those aspects, lined up and ready, so that when things happen, again, not going to be fun. You're going to take time to process and all this stuff because you're disappointed, upset. You just started seeing your reserves and your income grow, and these properties are generating cash for you, and it's all great. And then all of a sudden something happens and that goes down, right? Because you have to absorb the event. But if you can't, because you don't have reserves, whether it be in kind of your real estate business or your personal life, very different situation, right? So I think it's really important to have, or to be prepared on kind of those 2 fronts, mentally and financially.
Totally. And I think as well, when you get a handful of rentals, for example, even if they're in multiple markets, the way I think about it, not from an accounting standpoint, but in my head, I think of the aggregation of all that cash flow as, let's say my Vegas properties are performing very well, but my Iowa properties had a few problems recently, and I need to do an owner draw from Vegas to go replenish my Iowa reserves. Like I'll do stuff like that. And from that perspective, I also think about like just keeping really clean books. Like, you and I both use Stessa, and we do our monthly reporting, and we see like, okay, where did we have overage? Like, where did we not have to draw down our reserves or maintenance? And where did we have to dip into it? And I think there's this like ongoing reconciliation of just, you can cross collateralize those repair and reserve allocations a little bit. Again, very clear, like do it in a clean way with your bookkeeping that's not going to compromise those from an asset protection standpoint. That's one thing where like getting a critical mass of like 6 to 8 rentals, it can help, because if one has problems, the cash flow from the others can help backstop you a bit, especially when your reserves start running dry. I don't know, do you think of it similarly or?
No, exactly the same. And I remember when I started, we might have talked about this last time on the last episode or 2, I can't remember, but precisely for what you just said, one of my goals early on was to get to a certain number of properties so that I have that diversification or de-risking kind of aspect to my portfolio. And should something happen to one of my properties, that the others could help absorb kind of the financial cost and help address any issues that come up. So 100%. You get to a point where, like you said, you have that critical mass or that critical number, whatever it is, where hopefully you get to a place where you don't have to think about contributing from your own personal funds or assets to go maintain, fix, repair your portfolio.
Definitely. And I think too, we talk about in our academy that when we talk about cash flow, we're usually referring to profit, and we're very, very explicit about when we talk about, $200 a month cash flow. But that's not the rent minus the mortgage. That is the rent minus the mortgage, minus an expense allocation, minus CapEx, maintenance, property management. That's the net. And I think sometimes people group their cash flow all into one bucket and just say, oh, this is just available money for whatever. And somewhere in between that I think is realistic, where all those allocations I mentioned, property management, maintenance, CapEx, I don't have a different bank account for those. But what I do is in my head and on our tracker, I do chop off a good percentage of the actual cash flow. I will not take an owner draw for any more than what I know is available above and beyond those allocations. So that's another topic, is the idea of like how you think of and account for profit. But do you have any similar like system?
Yeah, I was going to say exactly. It's probably a whole other episode because it's probably going to be more than a few minutes to talk about. But for our portfolio, the model that I follow is the profit first model. And while I think technically it might be one bank account, I'm not even sure actually, but I use online financial or tech systems not that are layered on top of the bank or the banking services that will automatically do that separation. So anytime money comes into the account, I have a certain percentage that goes to profit, certain percentage that goes to expenses, certain or reserves, certain percentage that goes to taxes, certain percentage that goes to owner profit, I think. No, I already said profit. I can't remember what it's called. But essentially, I have systems in place through fintech, financial technology services, and I use two different ones for our different LLCs that will do that automatically for me. So I don't even have to think about it. When money comes in, it is distributed across 4 or 5 different buckets based on certain percentages. So my hand's forced in that sense, which I love, frankly, because then I know I have reserves.
Yeah, definitely. So I know we're getting into more of like cash management, but I think the reason we went down that rabbit hole a little bit was because some of like feeling more secure and like you understand your accounting and bookkeeping system is what's going to also help you in those moments where you need that resilience. Because sometimes you just can't see through to the other side to say, okay, like how long is it going to take for this stuff to replenish? How long is it going to take? How well am I insulated against these big CapEx events and expenses? And just having like control over your books and also thinking about how you treat the profit in your business, it solves multiple problems. Like one, it shows you that there is still profit to be had at some point. You just got to like continue to fine tune the way your accounting is. And then two is that your reserves will build back, whether immediately or whether it takes 6 to 8 months. You just got to have the discipline to forecast that stuff out. So one other element of the are you playing the right game discussion, which again, this could be a spin-off episode too, but multiple markets, right? So you're in 2 markets, I'm in
Yep.
3, and I know a few of our members invest in multiple, if not several markets. And so I want to get your quick take on like, I've heard differing opinions. Some people have 10 markets they're in. Some people swear by only having 1 market. Where do you kind of fall on that spectrum? And like, do you ever plan to expand beyond the 2 that you're already in?
Yeah, that's a fantastic topic. And like you said, probably another whole episode. But I'm actually a very simple guy. I listen to those who are 10 steps ahead of me and I try to replicate what they do. And when I hear way more seasoned real estate investors who say they've gone through consolidation and they went from I was in 10 markets or 5 markets down to 2 or 3, they've done it for a reason. They've done it because they have more experience than I do. So I'm going to do the same. So because I hear these types of things, I very intentionally try to not go too broad into too many markets. That said, there is one aspect to be in multiple markets, let's say 2, maybe 3. I don't know what the right number is. I don't necessarily have an opinion on what that number is, but there's this aspect of de-risking your portfolio and kind of diversification if you're in several markets, because should you be all in one market and something happens to that market, the biggest employer leaves, just big stuff could happen, then that's your entire portfolio that's at risk. Whereas if you're in several markets, then you're kind of de-risking it in that sense. So I like being, in my case, I'm into, but I don't know what the magic number is. I would not ever go into probably more than 3 personally, primarily because of the process overhead of knowing 3 markets as well as I know the 2 that I'm in, having your network, the people, the property managers, it's different taxes, different fee structures from your property managers, different preferences for communicating, different realtors when you want to buy or sell a property. So all of that stuff is just, I don't want that overhead because I'm trying to stick to the 20 minutes a day and not spend more than the 20 minutes on my real estate and rental portfolio every single day. And I think that becomes really hard when you're dealing with more people, right? Just by nature of being in more markets.
100%. I feel very similarly. And I think you called out one thing, which is like de-risking or diversifying. That to me is the main reason to have multiple markets, not necessarily to like, you can find good deals in a lot of different places, right? So if I'm thinking only along the lines of, I want a 3-bed, 2-bath house that's got this profile, I don't care what city it's in. I just wanted to have this type of return profile in this type of neighborhood. You could probably broaden and find quite a few deals by casting such a wide net. But like you said, you're going to have to build teams in each market. You're going to have oversight and management and understand. You're going to have to manage your manager. You have to understand the local regulations, understand all the different neighborhoods and areas so that you're buying a good deal or not. I think one interesting trap that a lot of long distance investors fall into, and I have fallen into myself, is like when you're from California or Washington or somewhere on the East Coast, it's super expensive. Like the Quad Cities, which is in Iowa where I invest, when I first saw that you could get a 3-bed, 2-bath house for $150,000, my jaw dropped. And I bought one and it penciled and it has made good money for us. We got it on cheap loans, so it's working for us. But what I didn't realize is that every local around there thought that that was, 20% higher than it should be. But all this out-of-state money starts flowing in, and it's that relativity and our inability to translate what is actually normal in a market that can really skew your sense of what's normal. And so that was another lesson I learned. But I treat my markets as like, I basically couldn't afford to invest in Vegas anymore. The prices had run up too far. Same thing in Washington. I couldn't afford to invest in Washington anymore. And those were big growth markets where the values were going up, and then they also drew back in 2022. And so Iowa, it was like Washington and Nevada were my growth stocks, and Iowa was my dividend stock. Slow and steady, doesn't have a bunch of volatility, and it's not going to like live or die by what's going on in some of the more growth-oriented markets. So yeah, I think multiple markets, that's one where you're right, there's no perfect number, but I do think like 2 to 3 gives you that diversification, and it's still manageable with our kind of 20-minute investor system.
100%.
So, all right, we're just under the 20-minute mark, but I think that was a good discussion. I'm excited to share that with the member who asked about it. And I would love if anybody hears this and has any thoughts on the matter, reply in the video or tag one of us on socials. And we'd love to keep the conversation going. So on to the next one.
Thanks, man.
Thank you for making it to the end of today's episode. As you may know, podcasts are very difficult to grow organically. If you're getting value from today's episode, I'd deeply appreciate if you can take 30 seconds to leave my show a 5-star rating and review. This will go a long way to helping me reach more listeners just like you. Thank you so much in advance.